Thanks to the recent tax bill, retirees are now able to make over $140,000 in retirement and pay a grand total of $0 in federal income tax. Yes, you heard that correctly. And in this video, we're going to explain exactly how that's a possibility and explain how some of the factors that are included in here can lead you to minimize the amount of tax that you owe if you are in retirement, and more importantly, be able to enjoy this without having to pay Uncle Sam any more than you need to legally. My name is Danny Cieniewicz. I'm a CIP professional with Hyperion Financial, and we help retirees each and every single day plan and strategize to minimize the amount of tax that they owe legally and look forward to enjoying their retirement in the best way possible. And if you haven't yet, be sure to check out the description below, which will go through a quiz that you can actually fill out to give you an idea of how your tax plan shakes out. You can also check out HyperionFP.com for an assessment that will allow you to see exactly how much tax that you would owe on the income that you projected to bring in. So let's talk about this tax scenario, which again might sound bonkers to you, but due to the new tax law and the way that tax code is written, this is actually very conceivable. Let's meet our hypothetical couple. We have with us here Elijah and Mackenzie. And Elijah and Mackenzie are in retirement, both are over the age of 65. Neither are collecting their Social Security benefit yet. And frankly, there could be a little bit of nuance to how we wanted to decide how to do this, but we're going to say that they're both retired over the age of 65. And we're going to say that one of them is going to take a IRA distribution, and they're also living off of their investment account, their non-qualified brokerage account, which is going to lead to some long-term capital gains. I think the broader point is with much of the planning here, you can minimize your tax where maybe it's not zero, but it's awfully close to zero. Maybe you're not making $140,000, but you're making something close to that. Regardless, this new scenario that's just been put in place due to the one big beautiful bill allows retirees to utilize more income and have to pay less in tax. But remember, this is only temporary, as some of the things that we're about to discuss are only good for the next several years. So let's walk through the actual scenario of our friends Elijah and Mackenzie. So to illustrate this, we're going to take a look at our tax planning software, and it's going to show exactly how all of this does work. So while some people may be able to pay zero tax on $143,400 of income, others may not be so lucky. We're going to explain how we get to that number and why this is the case. So the first thing that we're going to look at is the fact that it is tax year 2025. So the law that was just signed here in July allows taxpayers now to take advantage of some of these provisions that are in here as of this year. So we're not going to say that this couple is making any earned income, but hypothetically, you could utilize some of this earned income if you take from another source, which is an ordinary income. But we're going to say that one of the two of them, let's say Elijah, decides to take a $46,700 IRA distribution from his IRA. If he were to complete this, this counts as ordinary income. So ordinary income, as you may be familiar with, is taxed at these ordinary income rates. Now, ordinary income rates are going to be different than long-term capital gains rates, which you're going to see here momentarily how those also work as well. But being that they're married filing jointly, both over the age of 65, they take out a $46,700 distribution. Now, if we scroll down here, we're going to say that they recognize $96,700 of long-term capital gains. Again, depending on how their accounts are set up, how their investments are set up, we're going to utilize $96,700 in long-term capital gains. Now, keep in mind, there are no short-term capital gains in this example. Short-term capital gains would just be taxed as ordinary income. So that being the case, we see down here that their total income is $143,400. Not a bad year when it comes to two retirees who are both 65. Again, we're going to say that neither of these are collecting their Social Security. But in this case, obviously, if they're both over the age of 65, perhaps one or both could realistically be collecting Social Security. All that being said, we see down here that the adjusted gross income is the same as the total income. And we notice that the standard deduction that they're going to utilize is $34,700. Now, you may recall for ages 65 and above, there is an increased standard deduction that you're able to utilize and take advantage of for married filing jointly couples. It's $1,600 per person in that couple if they're both over the age of 65. The other thing that they're able now to take advantage of is the increased standard deduction that was raised for everybody across the board due to the one big beautiful bill. But there's another factor that's in place that they can now take advantage of, which is even sweeter. The $6,000 standard deduction increase for folks who are over the age of 65. Now, for married filing jointly couples, you need to be under $150,000 of modified adjusted gross income to take full advantage of that amount. But being in this case, they are under the $150,000 of modified adjusted gross income, Both Elijah and Mackenzie can take advantage of the $6,000 standard deduction increase, thus pushing their total standard deduction to $46,700. Now, there's still $96,700 of taxable income, but that taxable income is at the long-term capital gains rate. If we look down here, the total tax is $0. Well, why is that? Because the long-term capital gains rate of $96,700 is taxed at the 0% rate. Not a bad rate to be taxed at. And again, being that these are long-term capital gains, they are treated more favorably by the IRS. To some degree, it almost doesn't seem fair that this is a possibility, but this is the reality of how the tax code works, which brings us to an important point. How are you currently taking income in retirement? And are you aware of what the tax ramifications are of taking from each source? If you're able to combine long-term capital gains, which are taxed at a more favorable rate, along with ordinary income, such as IRA distributions or wages that you may be earning, perhaps you have a pension, or perhaps some of your Social Security benefits are taxable. If any of that is the case, and you look at all these in combination, you can make sure that the levers in which you're pulling or the income sources in which you're taking are done so in a way that's maximized for tax efficiency. Now, one thing I will mention is it's important to make sure that you are looking both at this year, but future years. You may want to take advantage of strategic moves to lower future RMDs. You may want to take advantage of being in a lower tax bracket because you may not be in the 10 or the 12% tax bracket for future years. So maybe in this case for Elijah and Mackenzie, it might make sense to take even more than what we just showed, the $46,700. Making sure you have enough to live off of in retirement, but then making strategic moves on top of that can allow you to enjoy today's dollars, but also enjoy retirement in the future. And make sure that taxes are one of the things that you're least concerned about as you move forward. So what are the three things that Elijah and Mackenzie did correctly? Well, number one, they put themselves in position where they could actually pull from these different levers. Instead of just saving all in a pre-tax account, they diversified their income sources as well from after-tax accounts. Now, let's say they could also have a Roth account, which would be additional income, and perhaps they're not even recognizing any tax on that. But they also do have a pre-tax account as well. The $46,700 that they recognize is taxed at a 0% rate. But by diversifying your income sources, you can make sure that you keep your taxes low. So by them saving into different vehicles on the way up, it allows them to pull different levers in retirement and thus put themselves in a position where in this case, their federal tax liability is zero. The second thing that they did correctly was exactly that. They pulled from the right sources. So by saving in the right sources, they could then pull from the correct sources. The more options that you give yourself in retirement, the better you are. And just like you should be diversified in a portfolio, handling the risk and reward of the market, you should also be diversified when it comes to taxes because we just don't know what the future holds with taxes. So what's the third thing they did correctly? Frankly, they got lucky. This is a scenario where there was much talk about no tax on Social Security. There was talk of different ways in which seniors could benefit. But clearly, the one big beautiful bill did benefit seniors. This is something that for many people is outside of their control. Did they see it coming? I can't say I fully did. But as a result of this being passed, it now opens up new possibilities for retirees. This option allows you to collect over $140,000 of tax-free income in retirement, which should get you thinking. It's not necessarily about how much you make, but the plan that you have in retirement, which can best set yourself up from a tax standpoint, an income standpoint, an investment standpoint. It's been said over and over again. The tax code itself rewards those who are educated. It rewards those who know what the tax code entails. So if you are aware of some of these strategies and you can put them to good use, you can minimize the amount of tax owed. Otherwise, you're going to be putting less enjoyment that you can have and sending that off to the IRS. For most retirees that we've met with, it's a pretty obvious choice which they would rather choose. If you're more interested in making sure that you get to keep more of what you've saved, what you've risked, and what you've earned, that's something that we definitely help with at Hyperion Financial. Be sure to check out the link in the description below and check out HyperionFP.com to learn how you can get your free assessment and understand how you can best minimize the amount of tax that you owe and enjoy the amount that you've saved to this point. Lastly, one thing that also affects retirees are IRMA thresholds and Medicare premium surcharges. If you're interested in better understanding these and how you can avoid them, make sure to click right here that you have a better idea of how you can avoid these taxes and put yourself in a position where you're able to enjoy more of what you've earned.